Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets hidden in plain sight within corporate filings. And sometimes it seems like a company is trying to pull a fast one, or maybe just needs more time to find that perfect business to buy. Let's dive into Cartica Acquisition Corp's latest report and see what is really going on. So, what is the big news here? It looks like Cartica Acquisition Corp is essentially buying themselves more time to find a business to merge with, and they're doing it by using their own funds to extend their deadline. It's like they're saying we need a little longer to find the right partner, so here is some money to keep the lights on. This report is a standard Form 8K, which means something significant happened that the public needs to know about, and it is filed under the rules of the Securities and Exchange Commission. The earliest event reported here happened on the 3rd of October, and the report itself is being filed on the 9th of October. This tells us the company is being timely in its disclosures. The company we're looking at is Cartica Acquisition Corp, and as a special purpose acquisition company, or SPAC, their main goal is to find another company to buy or merge with. They raise money through an initial public offering with the sole purpose of acquiring a business. It is worth noting that Cartica Acquisition Corp is incorporated in the Cayman Islands, which is a common practice for many companies, especially those looking to go public. Their main point of contact for inquiries like this is listed at a New York address, and the phone number provided is what they consider their principal executive office contact. Cartica Acquisition Corp has elected to be an emerging growth company. This status allows them to take advantage of certain regulatory flexibilities, sometimes meaning they can delay adopting new accounting standards. Now, let's get to the meat of this filing, item 1 point. 01 talks about entering into a significant agreement. On the 7th of October, the company issued a promissory note. This is essentially a loan agreement. This loan is for up to about $148,000, and these funds are being called extension funds. This immediately tells you the purpose of this money likely relates to extending something. These funds are going into their trust account. If you're not familiar with SPACs, the trust account is where the money raised from the IPO is held, to be used for acquisitions or returned to shareholders if no deal is made. This is a bit of a mouthful, but it is crucial. The money is for the shareholders who still hold their original shares from the IPO, which happened way back on the 7th of January 2022. The key here is that the company needed to extend the deadline to complete its business combination or acquisition, and this note is funding that extension. The original deadline was the 7th of October 2025, and it has now been pushed to the 7th of February 2026. So, to keep their SPAC alive and kicking, Cartica Acquisition Corp will deposit about $37,000 each month into the trust account. This is about 4 cents per S-hair for the remaining shareholders. This funding will continue until February of 2026, at which point they absolutely must have found a business to buy, or they either have to start winding down. The total they can put in is capped at that nearly $148,000, so it is a structured way for them to keep extending their search. And here is a critical detail about this loan for the extension. It doesn't earn any interest. This is a good deal for the company. The money from this note will be paid back either when they successfully find a business to merge with, or if they have to liquidate, meaning they return the remaining money to shareholders. This note was issued under an exemption from registration, meaning they didn't have to go through the usual lengthy process of registering it with the SEC. This is typical for private placements of this nature. Item 2.03 covers new financial obligations. Essentially, this section just refers back to the promissory note details. We just discussed the loan becomes a direct financial obligation of the company. Now we move into shareholder votes. In a SPAC, shareholder votes are common, especially when it comes to extending deadlines or approving mergers. On the 3rd of October, the shareholders met for a special meeting to vote on a few key proposals. The first big vote was to officially extend the deadline to complete a business combination. They voted to push it from the 7th of October 2025 all the way to the 7th of February 2026. This means they are pushing the decision day back by 4 months. The second item was to approve their auditors for the year. This is pretty standard procedure. The third proposal was an adjournment vote. This is a backup plan. They could postpone the meeting if they didn't get enough votes for other proposals. Let's look at the results of that crucial extension vote. The extension amendment proposal received a whopping 6,486,120 votes in favour, and 0 votes against or abstaining. This is a clear win and shows strong shareholder support for giving the company more time. As expected, the proposal to extend the deadline passed overwhelmingly. Now, for the auditors. Again, a perfect score here. All 6,486,120 votes were in favour. So, CBCPASPC will continue to be their independent auditors. And the adjournment proposal also received the same unanimous support. However, it is not all smooth sailing. A significant number of shareholders, holding just over 420,000 shares, decided to cash out. They exercised their right to redeem their shares, meaning they got their initial investment back from the trust account. This redemption cost the company approximately $5.2 million. This is a substantial amount, and it means that less capital is available for future acquisitions. Each redeeming shareholder got about $12.46 back for their share. After these redemptions, the number of outstanding public shares has dropped to just under 1 million. This concentration of remaining shareholders might make future votes easier to pass if they continue to support the management. The official amendment to their corporate documents reflecting the extended deadline was filed in the Cayman Islands on the 9th of October. Item 8.01 is for any other events that are important for investors to know about. This section explains how the money in the trust account was originally managed. After their IPO, they put $10.3 per unit into the trust, invested in very safe, short-term US government securities, or money market funds. This investment strategy is designed for maximum safety of principal. Sometime in early 2024, they moved the funds out of those ultra-safe investments into a regular interest-bearing bank account. This might signal a slight shift towards seeking a bit more yield, though still within a very low risk profile. And most recently, after those shareholders redeemed their shares, the remaining funds in the trust account have been reinvested back into US government securities. This shows a continued commitment to capital preservation while they continue their search. Finally, item 9.01 lists the exhibits filed with the report. This would be the legal document showing the change in their articles of association to reflect the extended deadline. And here is the actual promissory note we discussed, filed as an exhibit. This is the interactive data file for easy machine reading of the report. S-Core information. Now, looking at this filing, Cartica Accession Corp is essentially in a holding pattern. The primary action is the extension of their deadline, funded by a zero-interest promissory note from their sponsor. This tells us the sponsor is committed to giving the company more runway to find a suitable acquisition. The overwhelming shareholder approval for the extension indicates that most remaining shareholders are also willing to wait longer for a deal, especially with no risk of further dilution from their perspective. The significant number of redemptions, however, is a double-edged sword. On one hand, it reduces the amount of capital available for an acquisition. On the other hand, it means fewer remaining shares outstanding, which can make it easier to get deal approval and potentially achieve a higher valuation per share for the remaining shareholders. The fact that they've had to extend multiple times since their IPO in 2022 does raise a flag about the difficulty of finding a target in the current market, or perhaps the attractiveness of the targets they've evaluated. The company's direction is clear: continue searching for a business combination. The most notable risk here is the ticking clock. They have until February 2026 to strike a deal. If they don't, the company will liquidate and the remaining trust funds will be returned to shareholders. The opportunity lies in finding a strong business at a good valuation. Given the low interest environment and high SPAC redemptions across the board, it's a tough climate for SPACs. Their strategy is one of patience and capital preservation, funded by committed sponsors. In conclusion, Cartica Accession Corp is buying time, and their shareholders are giving them that time. The success of this SPAC hinges entirely on whether they can find and close a merger before February 2026. The redemptions show some shareholders lost faith, but those who remain are largely supportive of the extended search. Alright, that is our breakdown of Cartica Accession Corp's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, see you next time.